Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Our topic is limited liability company. And we'll begin with our objectives, which are at the end of the lesson, you should be able to identify the key features of a limited liability company, list the advantages and disadvantages of a limited liability company, and define the key terms associated with limited liability company. So those are the objectives. And we're going to move into the definition. What is a limited liability company? A limited liability company is a business whose owner's liability for the business's debt is limited to the amount of money that they invested in shares in the business. So their personal possessions cannot be lost. So it depends on the amount of shares that the individual, the shareholder, has purchased in the business. The business's debt is limited to that amount that they have invested. A company is seen as a legal entity, a separate legal entity from that of its shareholders, in that it can sue and be sued in its own right. So the shareholders, which are the owners of the company, are the business is separate and apart from it. They're basically seen as two different persons there, because you can look at the business because it's a separate legal entity. You can look at it as a person basically. So it can sue, or it can be sued in its own right. Now, let's look at the features of a limited liability company. What are the features? The first one, capital is raised by the issue of shares. So by selling shares, basically, that's how they raise the capital. The next one is they have unlimited ownership. They can have several shareholders. So the first one, capital is raised by the issue of shares, and they have unlimited ownership. The next feature is shareholders receive dividends. So these individuals, shareholders, are persons that purchase shares within a company. So now they're seen as owners of the company. But what do they get for investing in that company? It is called dividend. So the share of profit that these individuals get for investing in the company is referred to as dividends. That is what they receive as owners of the company. Next, separate legal entity from its owners. And we have looked at that earlier in the definition. Remember, it can be sued, or it can sue in its own right. Next, run by directors. The company is run by its directors. The directors may be shareholders or may not be shareholders of the company. These individuals are appointed by the shareholders to have ideas and to take on the workload of the business. So the business is run by the directors. And remember, these persons are appointed by the shareholders. Next, must have audit and publish accounts. So the financial statements of the company must be audited and it must be published. Okay? And that is if it is a public limited company. The private one, the financial statements are held in private. These are not published. Next, risk is limited to the amount invested in the shares. Remember, we have looked at limited. So the amount of risk that this shareholder would have, it would be limited to the amount of shares that they have purchased in the business. So they may not be asked, they will not be asked basically to use their personal possession to cover any debts of the business, because it is limited to the amount of shares that they have purchased in the business. So let us look at why. Why would someone be a part of a limited liability company? Why would you purchase shares in a limited liability company? And these are the advantages of the limited liability company. So here we go. The first one, the owners which are called the shareholders of the company, have limited liability. Next, in law, a limited company is a separate legal entity, and we have looked at that earlier. That is a feature of the limited liability company. Following that, we have capital can be more readily raised to fund expansion because you're able to sell the shares and persons can purchase shares within the business, and the shares that they purchase in the business basically increases the amount of share capital. We refer to it as share capital. Next, continuity. And what do we mean by this? Unlike the shareholders or partnership, the company can be dissolved, but the company has basically unlimited life then, but it can be dissolved. In dissolving the company, it can be done by a court order, and that would be a judicial dissolution. It can be done by the approval of the majority of shareholders or the expiration of the company's powers. So remember, it has continuity. The lifespan of it is longer than that of the sole trader, because if the sole trader dies, the business dies as well. And for the partnership, if a partner should leave the company or so, then that business basically dies. Next, larger companies can offer incentives to their employees by giving shares and or offering employees opportunity to purchase shares at an advantage price. So they may sell them the shares at a discounted price then. Okay. Next, shares in a public limited company are listed on the stock exchange and can therefore be easily bought and sold. So I've mentioned public company there. Yes, we do have private companies as well. And a private company cannot sell their shares on the stock exchange. So that would be a disadvantage when we move over to disadvantage. But the difference between a public and a private company is that a public company is one which is free to ask members of the public to subscribe to or purchase its shares, while a private limited company can only sell shares to family members or close friends. They cannot sell the shares on the stock exchange. They're not listed on that. The public limited company, legally, a public limited company can only be formed if there is a minimum of 7 persons seeking its formation. And remember, there is no maximum to the number of persons that are part of the public limited company. While for the private limited company, the minimum is 2 members and the maximum is 50 members. Okay, so remember, the public minimum 7 individuals, 7 owners, seven persons, while there is no maximum. For the private limited company, there is a minimum of 2, maximum of 50 members or shareholders, basically. Now let's look at the reason someone would not basically want to be a part of a limited liability company. And we're looking at the disadvantages of a limited liability company. Why not a limited liability company? Here we go. The first one, must conform to government regulations and legislation. Following that, shares in a private limited company can only be bought and sold in private. Remember, I mentioned you can only sell shares to family or friends. You cannot list it on the stock exchange. Next, decision-making process can take a longer time to achieve. Remember, you have several persons that are part of this business. So therefore, it may take a longer time, for decision to be made. Too many persons. Next, public limited companies' financial data no longer remains private since it has to be published. Remember, the financial statements, a feature of the limited liability company is that the financial statements must be audited and published. So the fact that it has to be published, it is no longer private. Next, Larger organizations can lose personal contact with their employees who lose interest as a result. Too large. So therefore, that close relationship that you would have with your employees may be difficult, and some of them may just lose interest and believe as if they don't really belong in this business. Okay. Now, let us look at some key terms that are associated with a limited liability company. Key terms associated with limited liability company. And here we go with the first one, and that is limited liability. The liability of any shareholder, remember the shareholders are the owners, to the debts of the company is limited to the amount of their fully paid up shares. What do we mean by this? The amount of shares that they have purchased in the company, the amount that they have invested in the company. Okay, and you can look at it as the outstanding shares as well. Outstanding shares means that these are the shares that have been sold to the shareholders. Okay, next we are going to look at shareholders, and I've mentioned earlier, and we're going to look at it now. These are the owners of the share capital of a limited company. So once you purchase shares in a company, you're now an owner, and you're referred to as a shareholder. Next, directors. Directors are officials appointed by the shareholders to manage the company for them. A director can be, but does not have to be, a shareholder. So remember, the director can be a shareholder, which is an owner, or they don't have to be an owner or shareholder. Next term is shares. The term shares have been mentioned so many times since the beginning of the lesson. What do we mean by shares? The capital of a limited company is split into parts called shares. So if it is that you want to invest in a company, what you would do is to purchase parts of the capital. And by purchasing parts of the capital, it means that you are purchasing shares in the company, and that would be your investment. Next, nominal value. Nominal value is basically seen as the face value or par value. And what do we mean by that? It's the price description of an issued share under the company's constitution. The price description of an issued share under the company's constitution. So they may mention that they're selling the shares at a par value of $1. That is the face value of the share, or the nominal value. Remember, nominal value, face value, par value, they are the same. Next, we have dividend. And this is what the shareholders get in returns for their investment. So it's the amount given to shareholders as their share of the profits of the company. That is dividend. Moving on, looking at some more terms, and the other term is debenture. What do we mean by debenture? So debenture is a form of loan to a company with a fixed rate of interest over a period of time. So debenture is a loan. Now, this interest that is charged on the debenture must be paid before any dividends are paid out to the shareholders. So you have to appropriate for that before you pay out your dividends to the shareholders. And the reality is the dividend must be paid after the interest, because dividends are paid out of the company's profit. In charging your debenture interest, it means that you'd have to get rid of this first before you can know how much profit that you have, and then decide to pay out your dividends to your shareholders. Next is authorized share capital. Authorized share capital. What do we mean by this? It is the maximum amount of share capital that a limited company is allowed to issue under its constitution. So basically, it's the maximum amount of shares that a company is allowed to sell. Issued share capital, issued share capital. This is the amount of share capital that the company has actually issued, which cannot exceed the authorized amount. When we say issued, it means that we mean that the shares are sold. Issuing shares means that you're selling shares. If within the business or within the question you're seeing, the company issued shares of 100,000, it means that the company sold 100,000 shares. But the issued share cannot exceed what the company is authorized to sell. Okay, it can be below or the exact amount that the business is authorized to sell, but it cannot be more than the authorized share capital. Next term, share premium. What do we mean by share premium? It's the difference between the nominal value of shares and the price at which they are issued. The nominal value is the face value, which is also the par value, and this is the price at which that is attached to the shares under the company's constitution. The shares can be sold for more than the nominal value, and the extra that it is sold for goes to share premium. That's what it is basically saying. So, for example, the shares, the nominal value for the shares is $2. However, the business sold those shares, the business issued those shares for $2.50. The extra 50 cents per share would constitute the share premium. Now, if you don't understand it that way, let's take a look at, say, for example, you have a tin of mackerel and that is the price for it is $100, but that is the original price. It was sold for $150. The $50 would be profit for the business, right? So the extra 50 there would be the profit. If we look at the shares with nominal value and share premium, so the nominal value of the shares is $2. However, it was sold for $2.50. The extra 50 cents, you can look at it as profit, but we don't refer to it as profit. It is referred to as share premium. So the extra 50 cents per share that they were sold for would constitute share premium. Next, we're moving into ordinary shares. And please note that there are two classes of shares. We have ordinary and we have preference shares. So we're going to look at the ordinary shares first. And these shares are entitled to dividends after the preference shareholders have been paid their dividends. Ordinary shares receive a variable rate of dividend dependent on the level of profit that is generated in the business. Ordinary shares normally carry voting rights, but please note that ordinary shareholders are paid dividend after the preference shareholders receive theirs. The reality is that after you pay out your preference shareholders dividend, if nothing remains, then it means that the ordinary shareholders would not receive any dividend for that financial period. Okay? So remember, ordinary shareholders receive dividend after the preference shareholders. Next is the preference shareholders, and this would be our final term. And the preference shareholders, they are entitled to a fixed rate of dividend that is appropriated of ordinary share dividend. Normally, preference shares are seen as low risk and do not carry voting rights. Low risk in the fact that once you purchase preference shares, it's almost likely that you're going to get your dividend. Okay? And these shares can be cumulative and non-cumulative. Cumulative means that if for a particular financial period you did not receive the amount of dividend that you should get based on the fixed rate, the next financial period you receive what you did not get the previous year, so basically the amount that was owing, along with what you are entitled to per year. If it is non-cumulative, it means that if you didn't get the shares in that financial period, come next financial period, they basically ignore that amount that you did not get because it is non-cumulative. So all you would get for that financial period is only that fixed rate associated with that year. So if you did not get all that you should get the previous year, it is almost like you have lost that dividend for that particular period because it is non-cumulative. Okay, so remember the difference between your ordinary shares and your preference shares is that ordinary get dividend after the preference shareholders receive theirs. So at no point in time, ordinary shareholders would receive their dividend before the preference shareholders. And that is it for our lesson on just the introduction of limited liability company. In our next session, we'll be focusing on journal entries for limited liability company.
Like, share, and don't forget to subscribe.